Hello, good morning, everybody, to my finance warriors. Happy Sunday. So, welcome. So, for those of you who don't know me, my name is Chris Manfre. I'm one of the lead instructors at the American Institute of Finance. And as you know, or you don't, if you haven't attended before, during these short sessions, study group sessions, basically we investigate some aspects of finance that can be of interest both from a theoretical standpoint but also from a practical standpoint, to see how we can really put in action some of these ideas in the market. And so today we're going to talk about bonds. And so I will also try to guide you through, in a practical manner, how you can get started to invest in bonds. And I don't know if you've done it. Very often we start investing in stocks, right? Everybody perhaps gives it a try, but when we talk about bonds, perhaps we have not looked into that yet. We might have a general understanding on how that works, but I hope that with today's study group session, you get an additional understanding with regard to how bonds actually work and how you can actually buy them in the marketplace. All right, so let's go to the first slide. What is a bond? Companies borrow money, we know that, and they borrow money for various reasons. Sometimes if they don't need money, they might just do so in order to lower their cost of capital. And we talked about cost of capital a little bit before during the previous study group sessions. So obviously when a company initially wants to borrow money, it can simply go to the bank, Bank of America, Wells Fargo, Citibank, and ask for a loan. So the first question perhaps is, why would we have bonds when a company can just go and get a loan from the bank? Well, the reason is that a small loan, let's call it even $10 million or $20 million, would be okay, and a bank can be willing to actually loan the money out to a company. But once the amount becomes too big, basically no institutional lender, no depository institution would probably be willing to risk, right, lending all that money to a specific company. And in fact, even for intermediary amounts, we can think of $50 million, $100 million, perhaps companies want to borrow that amount of money. So banks create a syndicate. So we have now 3, 4, 5 banks that altogether are going to loan out a certain amount. But if the amount becomes even bigger than that, we're talking about hundreds of millions of dollars or even billions of dollars, we are going to need bonds very likely, because bonds can be split in small portions. And I anticipate now that typically the par value of a bond is $1,000. So, a lot of different investors can just risk that $1,000, the par value of the bond, and to have a piece of the loan. And so these companies would sell bonds, which are debt contracts, as you can see in the slide. So anyone typically who can afford it can purchase these bonds. And these bonds are issued by investment banks in a similar fashion to the way stocks are actually issued in the marketplace. Yeah, we can go to the next slide. So what does the price depend on? Well, the price of bonds fluctuates in the marketplace similar to what actually stock prices behave. So we see the price going up or going down. Now I want to emphasize, as I mentioned before, that actually the initial price of a bond is $1,000. So with the first time you buy the bond is $1,000, but then the moment it starts trading in the marketplace, now we see the price going up and down. So what does the price depend on? Well, you can see here on the slide, obviously interest rates play a very important role in the pricing of the bond. Also the amount that is promised, the possibility of default. Now, if we go a few slides down, you can see the chances of default. There you go. So you can see chances of default depends on what? Well, economic conditions, industry conditions, the specific features of the company, whether there are specific covenants that protect the bond, right? And the possibility of repayment if there is default. So all these elements definitely have an impact on the chances of default, right? And the possibility of default will impact, obviously, the price of the bond and also the rating that the bond will have. As you probably heard, right, the rating rate agencies, we know Moody's, we know S&P are the ones that typically assign a rating to these companies when they issue bonds, right? And that will also determine basically the price of the bond. So let's go back to there you go, what the price depends on. And so if we move to the next slide, now we can look at the quotations. So something we need to be familiar with is the basis points, right? You probably heard of it. And a basis point, basically one basis point is 100 of a percentage, right? So 100 basis point, in other words, is 1%. Again, I repeat that. 100 basis points, right, is 1%. So very often we refer to basis points when we talk about bonds. Why is that? Well, because a small change in the interest rate might highly affect the price of the bond. So we cannot just go by 1% or 2% or 3%, right? A few basis points that are moving up or down might affect substantially might impact substantially the price of the bond. And so if we have 6.8%, it would be obviously 680 basis points, or we might say 6 plus 80 basis points. Another thing that I wanted to emphasize that I briefly mentioned before is that the way we price bonds is typically, again, a percentage of the par value, right? The par value, as I mentioned, typically is $1,000. So if we say 100, it means 100% of the par value, which means $1,000, right? If we say 90, it means 90% of the par value, which means $900. So I hope that is clear, because the way we refer to prices for bonds is a little different compared to stocks, right? Stocks is fairly straightforward. We don't have this nomenclature, special nomenclature. So for bonds, we need to understand the lingo, but there's nothing complex about it once you know it. So when we trade bonds, we need to understand yield curves, okay? Yield curves, in essence, identify the spot rate, right, with different types of maturity, right? So specifically on this chart, which doesn't contain a lot of information, but basically on the x-axis, you would have, let me see if I can just scribble on it. So on the x-axis here, we would have time, right? And on the y-axis, we would have a percentage, right? We would have a percentage. So what happens is that here we have zero maturity, and then we continue moving towards the right of this chart. So we could have, 1 year, and then we would have 2 years, and so on and so forth. And let me see, 2 years, and then 3 years, and so on and so forth. So what happens typically is that the longer the maturity, and again, the maturity refers to when the bond is going to be repaid to you. In other words, if you invested $1,000 into a specific bond today, and then for, let's say, a maturity of 10 years, after 10 years, you will receive, right, and this is today, after 10 years, you will receive again your $1,000, sorry, your $1,000. Okay, so maturity is when you receive the par value, the principal value, the principal value back. Okay, so depending on when you receive your principal back, your investment back, the interest that you can receive on that particular bond is going to change. Now, how is it going to change typically? Would you expect a higher interest rate or a lower interest rate the longer the maturity? Well, it's not an easy question, above all during these economic times, because we've seen some anomaly in the marketplace. But what I can tell you is that normally what happens is that the longer the maturity and the higher the interest rate. Again, let me repeat that. The longer the maturity, so the more we move to the right on this chart, the higher the interest rate that you will receive on your investment. And that makes sense because there's more uncertainty over a longer period of time. For example, imagine a 10-year maturity. I mean, over 10 years, a lot of different things might change. Interest rates might go up, they might go down, right? So I want some coverage for that risk that I'm willing to bear, right, for a longer period of time, and therefore I will receive a higher return, so to speak, which is a higher interest rate in that case. Okay, so we reviewed some important ideas here. First of all, I explained maturity. Again, maturity, you invest the principal amount initially, and then you will receive that amount no matter what happened to the price during that time, which is a very important point, by the way. Right? So if you invest $10,000 and you wait for maturity, you will receive $10,000 unless the company defaults, right? No matter what the price has done during that period, which is a very important feature that pertains to bonds. Okay. Now you can see here down below, I say suppose a commercial bank, same slide. Suppose a commercial bank borrows for 1 year and makes a 5-year loan. Now you can see that the commercial bank is allegedly borrowing at 1%. Let me see if I can. At 1%, and then is going to loan it out to us, perhaps consumers, right? To buy a car, to buy a house at 4%. How is the bank doing? Well, the bank is doing pretty well, right? Because there is a spread, we call it spread, between 1 and 4 of 3%. And that is basically the profit for the commercial bank. And that is what typically banks actually do. So nowadays they can borrow at the very low rate from the Federal Reserve, right? And then loan out back to consumers at a higher rate, right? That's the spread, and that's how they actually make money. Okay. All right. So now let's move to the next slide. So continuing on the yield curve, yield curves are very interesting and very important. I told you that normally the yield curve should be upward sloping, but we could have situations where we actually have a reverse situation, right? Where the yield curve, like in the last example on this slide, you can see it with the downward slope, right? Now, typically, that indicates the possibility of a recession, right? Within a certain period of time, within a year and a half, right? That could be, and in fact, we have seen inverse yield curve, right, before actually the pandemic. Although the pandemic was allegedly unexpected, so we don't know if that was because of a possible recession that would have occurred in any event, or for any other reason. Now, the problem with the inverse yield curve is that it doesn't always get it right. So you might have an inverse yield curve, but it doesn't mean that for sure you will have actually a recession, an economic downturn, right? But again, we need to pay attention to the yield curve, and specifically, if we invest in bonds, we really need to focus on the yield curve and understand how it changes over time. Now, you can see here, I have a link, and we can click on it. So, because you know that I like to show you in practice how things work, not just the theory, right? So if you click there and you go basically to treasury.gov, right? Treasury.gov, this is the US Department of Treasury. Now you can see the yield curve if you scroll down below, and you can see the dates on the left hand side, right? And you can see the maturity up above. Up above you can see, so the first column is the dates, and then you can see up above the different maturities, right? As I mentioned in the chart, right, moving to the right, you're going to have different maturities, and the maturities become longer and longer and longer, and typically they go from 1 month to 30 years. So those numbers are actually percentages, okay? So if you look at the first date, July 1st, 2020, and 1 month, you can read 0.12. That means 0.12%. Now, if we move all the way to the right, let me see if I can actually circle that, right? If we move all the way to the right, you see 1.43, and that means 1.43%. So you can see that in this moment, the yield curve seems to be upward sloping to a certain extent, right? Because obviously 1 month has a interest rate that is lower than it is for 10-year, 20-year, or 30-year Treasury bond. Now this yield curve is just for Treasury securities, right? Going from Treasury bills, Treasury notes, and Treasury bonds, right? Now, if we scroll down, and let me first just erase the drawing here. So if we scroll down, now you can see that Friday, July 31st, 2020, which was basically last Friday, you can see the yield curve exactly for that specific date. So you can appreciate that the yield curve changes constantly, right? You can see even during the last month, this yield curve has been changing quite a bit. So when the yield curve changes, obviously the price of the bond that you bought, for example, will likely swing up and down. Okay, so that is why we're so interested in what happens to the yield curve. Okay, so let's go back to the presentation. Okay, there you go. All right, so moving on to the next slide. We talked about that. Okay, we're going to briefly talk about 3 bond types. Okay, there are more types, but today I briefly wanted to introduce you to 3 types, the main 3 types, which is pure discount bonds, coupon bonds, and consols, as they're called. Bonds can have different features, by the way, and these features can be attached to this 3 types of bonds. So they can be callable, they can be convertible, they can have a declining balance. And then we can also refer to exotic bonds, but we're not going to talk about exotic bonds today, which are bonds with specific features, right? It might be somewhere in between equity and debt, right? They might have warrants attached, they might have very different features, okay? But we're not going to talk about those today. So we're just going to talk about pure discount bonds, coupon bonds, and consols briefly. So let's move to the next one. Okay, zero coupon bond. A zero coupon bond, as the word says, basically does not pay a coupon. What is the coupon? The coupon is the payment that we receive, right? Either every year or every 6 months for having investing in a particular bond, right? But in this particular case, there is no coupon. We don't receive an intermediate, so to speak, payment during the period that we invest in this particular bond. So let's say we invest today into a bond, and it is going to mature in 5 years, right? That means that we will not receive any payments during these 5 years. We will just receive the par value at maturity. And the par value, as you now understand, is typically $1,000. But does that mean that today we would pay $1,000? Well, no. No, because we're going to receive $1,000 5 years from now, right? $1,000 5 years from now. So that means that today we're just going to pay a discounted amount, right? So let's say we're going to pay, I don't know, $600, for example, right? We're going to pay $600 today, and we're going to receive the full principal amount 5 years from now, assuming this is a 5-year pure discount bond. Okay. All right. So, in fact, you can see a concrete example right down below, right? And in this case, we want to determine the price of the bond. So we don't know what the price today is, right? In my first example, I said $600, and then $1,000 will be received 5 years from now. Now, down below, you can see it's a 10-year zero coupon bond. We will receive the $1,000. We know that the interest is 8%, and so we discount back for 10 years, and we get $463. Okay, so again, no payments in between. Okay, let's go to the go to the coupon bond. Okay, a coupon bond actually pays the coupon, right, as the word says. So what happens, as you can see in this example, the coupon is paid every term, right? Again, this is typically semi-annual or per annum, right, during the period that we hold the bond, right? So if it is a 4-year bond and it pays coupon every year, we're going to receive the 4 coupon payments, as you can see in the slide, right? Time 1, time 2, time 3, and time 4. Okay, so we will be receiving those coupon payments, and then at the end, we're also going to receive $1,000, right, at the end once the bond actually matures. Okay, you can see an example here for the bond, right, for the coupon bond. Right, so you can see that this particular bond pays $50 every period, right, for 20 periods, and you can see what the interest rate is, which is 6% here, right? And so we can figure out actually the price of the bond by discounting to present all the payments that we receive for holding this bond. Okay, so we receive the $50 every period, and then we receive the $1,000 at the end. Okay, so those payments are fixed, and they come in every period, differently from equity or stocks, where we don't know, even if there is a dividend payment, we don't know what the dividend payment is going to look like, what it's going to be, right? Because it's going to be declared by the board every single time or every year or every period, so we don't know. In this case, we do know, and we know that in this case, the payment will be $50 every period. So going to the next one, the last one is the console bond. Okay, a console bond is a very atypical, would say, type of bond because it does not have maturity. Okay, again, I repeat that, it does not have maturity. You're saying, well, you just mentioned that maturity is an intrinsic feature of a bond. I know, but this particular bond doesn't have maturity. And so it behaves very similar to preferred stock, I would say, where you receive the coupon payment forever, right? You receive the coupon payment forever. And you can see the formula of the console bond. So C stands for the coupon payment, and R is for the interest rate. Now, this type of bond is not very common. It was issued in the past by the UK government, and I think there are still some of these bonds outstanding, also because they continue in perpetuity, but they have not been issued again since then, which also because I don't think it's necessarily a good deal for the government to issue these types of bonds. So again, with this, we looked at pure discount bonds, coupon bonds, and console bonds, the 3 types of bonds that I wanted to talk to you today. Now, for the last few minutes, I just wanted to walk you through practically what you would do if you want to buy a bond. Because again, we always talk about the theory, but then once I ask my students sometimes, have you ever bought a bond? they say, well, I know what a bond is, but I have no idea how to get started. Okay, so as you can see here, this is my account, one of my accounts, and it is with Ameritrade, TD Ameritrade, which is a brokerage firm. Again, you don't have to do it with TD Ameritrade. This is not publicity for TD Ameritrade. Don't get paid to say this. You can choose any brokerage account that you like. You know, you can choose E-Trade, you can choose Ameritrade, you can choose Robinhood, whatever you like. Now, in every brokerage firm actually will provide this information to you in a different way, right? So this is just the way that my account looks like. But you can see that I selected Bond Wizard on the left, right, on the left, and now this particular page appears. So now I have to basically fill out or answer these questions one at a time, and then automatically there will be some options available to me if I want to purchase a bond. So let's look at the first question. I'm going to do this with you guys. So what type of account are you purchasing an investment for? And I say regular taxable account, right? So let's click regular taxable account. Let's see the second question. Does the income from the investment need to be tax exempt? Well, this deals with the idea whether you want to buy municipal bonds, which I haven't talked about, or not. Municipal bonds are issued by state and local governments, and sometimes they have some tax advantages. But we haven't really talked about it, so I'm going to say no, I don't need the tax exempt investment. Moving on. When do you need your investment returned? Okay, this is about the maturity. We talked about maturity. Now, let's say we're going to select 5 to 7 years. You can select anything you like, of course. We continue down. Now, we mentioned about ratings, right? So let's say I want to be relatively aggressive and I'm willing to go with the BAA. And again, you can see that you have the double rating. There's Moody's and S&P, so BAA lowercase, and then the triple B, that those refer to the same type of bond. Okay, and then if I continue down, it says, what type of product are you interested in? I would just deselect CDs, certificate of deposits. I deselect agency bonds. I deselect treasury bonds for now, and I deselect STREPS and zero coupon bond. I just want to stay with corporate bonds, just with corporate bonds. So let's run the search, and there you go. So down below you can see one thing I want to clarify is that this particular bonds are not newly issued bonds. Okay, these are outstanding bonds, bonds that are already been issued in the past and are now trading in the marketplace. Again, remember there are two types of bonds. There are newly issued bonds, so bonds that are basically newly issued, brand new, right, and you're buying them today, or bonds that have been already issued in the past. So this particular bonds have been issued already in the past. So for example, you could have Nordstrom Inc., right? So we can click on that one if you like that particular bond. And now we can learn more about this particular bond. And you can see if you want to buy this bond, there is a button up there that says buy, and we can just go there and click and buy the bond if we want to. So now you can see a lot of interesting information about this bond. The sector, now you can see if the bond is callable, the tax status, it is taxable, this particular bond, because of the selection that we made. You can look at the ratings. There's also a Moody report. So you can go there and click and read the report. I strongly suggest that if you want to purchase a bond, you should read it, right? Understand what you're buying. You can also look at the coupon. So the coupon down below is 4%. You can see down here. You can also see the current yield and the yield to maturity. And then down below, if you continue to scroll down, now you can see that the minimum quantity for this bond is actually 9 bonds. Now you will see this feature quite often. You need to buy a minimum amount of bonds. Typically it's more than one. You might have a situation where you can buy just one bond, but very often you have more than one. So in this case, they don't allow you to buy less than 9 bonds. So you would have to buy 9 bonds, up to 250 bonds. Now you can see the price, as I told you before, is indicated as a percentage of the principal amount or the par amount. So 87.368, that means 87.368% of $1,000. If you want to buy all the 9 bonds, this is what the principal is going to look like that you have to pay. So 7,863.12, and then there's an accrued interest, and so the total cost would be to you about $8,003 for 9 bonds. Okay. All right. I think our time is up. I see there is one question. Is this a good time to invest in bonds? I will answer this question briefly. Despite being excited this morning and learning about bonds, I would say it is not a great time to purchase bonds. And the reason is because interest rates are very low at this time. And so what happens is that if interest rates are going to increase in the foreseeable futures, as they probably will, the price of the bonds that you purchased is likely to go down. Okay, so again, you buy a bond now, interest rates are low. If interest rates are going to go up, then the price of your bond is going to decrease. Again, the relationship between the price and the interest rate is inverted. There's an inverse relationship. If interest rates are going to go up, the price is going to go down, and vice versa, right? If the interest rates are going to go down, the price is going to go up. So all in all, I would say it's not a great time to buy bonds, right? But obviously you need to judge for yourself depending on your objectives or on your investment objectives. Okay, guys, I guess our time is up. And invest safely, study hard, and I will see you next time.